Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of SNDL Inc., ticker symbol SNDL. So SNDL Inc., which was formerly known as Sundial Growers Inc., is engaged in producing and marketing cannabis for the adult use market. They've been in the news recently because they just announced that they are acquiring Valens in an all-stock deal that is valued at $106 million. So for each share of Valens, SNDL will be issuing 1/3 shares of its stock. This will add more than 500,000 square feet of cultivation and manufacturing space and over 185 cannabis stores under the Spirit Leaf and Value Buds banners. The company said that the combined company will offer a complete portfolio of branded products to consumers in Canada through its own supply and distribution channels. So coming off the back of that news, the company's stock price has not done much. Currently, they are trading at $2.30 per share, and year-to-date, they are down 67%. Since the company was publicly listed a little over 3 years ago, their stock price is down 97.5%. So this stock was extremely hyped up for its IPO and has just been down the tube since. Their business was one of the hype meme stocks in the first quarter of 2021, and since then, their stock price has been steadily down. Along the way, they've had some slight pump and dumps based off of some news, but overall, the business's stock price has just gone down the tubes. So they're trading just over their 52-week low, which is down 70% from their 52-week high. Over 12% of their shares outstanding are currently sold short, and they have a market cap of about $550 million US. Again, they just announced that they are merging with Valenco for $100 million. So they're spending nearly 20% of their market cap on that all-stock merger. For some more background about the business, SNDL Inc. engages in the production, distribution, and sale of cannabis products in Canada, where cannabis is legal. Some of its products include Lemon Riot, Daydream, Zenberry, Twilight, Tropical Bliss, Pillow Talk, Citrus Punch, and others. The company's primary focus is on producing and distributing inhalable products and brands, which include flower, pre-rolls, and vapes. Some of the brands include Sundial, Top Leaf, Palmetto, and Grasslands. Its three reportable segments are cannabis operations, retail operations, and investments. SNDL Inc. was incorporated in 2006 and is headquartered in Calgary, Canada. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of SNDL Inc. based off their business fundamentals. So this, again, was one of these hype meme stocks, but we're going to be investigating today whether they actually have anything behind the hype and determine exactly what their business fundamentals say about the company. This analysis will continue to evolve and improve over time, and it's an opportunity to learn in public. So with that said, let's get right into it. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So in all 5 of these years, SNDL is earning below average returns on capital. All of these years, they've had negative returns on capital. However, over the last 12 months, they're closing in on finally being able to produce positive returns on capital, so it does look like the business is making better business decisions. However, the company would still be burning money for each dollar that they're investing into the business, and they've had negative returns on capital overall, so this is going to be an X on metric number 1. This is pretty disappointing considering that the average business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is likely to return about what its underlying business returns, and those business returns are going to be captured here by return on capital. Disappointing to see this negative return on capital here, and this is an X on metric number 1. Next up, metric number 2, here we're taking a high-level overview of the cash coming into the business. So we want their revenues, net incomes, and free cash flows to have grown since the company has gone public. This metric is all or nothing in nature, meaning that either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. While their revenues from 2019 to 2021 are down, in actuality, year to date, they brought in over $200 million in revenue, so that is actually up. However, their earnings are still quite negative, as well as their free cash flows. And so while the business has been decreasing how much cash they're consuming, this is still going to be an X on metric number 2, as the business is not profitable. Metric number 4, here we're looking for earnings per share growth over this time frame. This one's going to be deceiving because they're spreading their negative earnings out over a larger share base overall. So since their IPO, SNDL has diluted existing shareholders by 2,400%. So they've issued 24 times as many shares as they had when they were initially listed. That is absolutely horrible for long-term shareholders because when you're purchasing a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And when a company issues new shares and dilutes existing shareholders, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to. So that is absolutely terrible shareholder dilution. Even though they've cut their earnings loss, they're still producing losses here. And so this is just another ugly X here on metric number 3. Metric number 4 is going to be pretty similar. Here we're looking for free cash flow per share growth, and we're seeing the same thing that happened with their earnings. These numbers are still negative, even though they're less negative than they have been in the past, but they're spreading it across a significantly larger share base. So this is going to be another X here on metric number 4. Metric number 5, we're evaluating how the company utilizes leverage. Here we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they produced in the past 5 years. So we don't want to be investing in overly levered businesses because over-leveraged businesses, aka businesses that have too much debt, most likely going to be at the greatest risk during economic downturns. At the end of 2021, SNDL had nearly $500 million in cash after paying off all of their liabilities. However, currently this is down to about $100 million in cash, and over the last 5 years, they've consumed over $500 million in free cash flow into their business. Based off of their run rate on how they're consuming free cash flows, it looks like the business is going to have to continue issuing shares to raise money, issuing new debt, or selling off assets to be able to support this free cash flow burn now and into the future. Even though the company has $100 million in cash right now, it looks like they are overly levered. So this is going to be another X on metric number 5. So far, we are 0 for 5 through 5 metrics. Finally, the big metric of them all, metric number 6, we want their average 5-year free cash flow to enterprise value yield to be above 5%. If this is the case, this will give us a slight risk premium to the risk-free rate. Total enterprise value is going to give us a more representative of the company's economic realities compared to their market cap alone. So total enterprise value includes both market cap and their net debt position. So it'll be more as if SNDL were a private business. So currently they have a total enterprise value of $485 million. And as we learned, in the past 5 years, they've consumed over $500 million of free cash flow. So that means that they have negative average free cash flows. And in fact, in the last 12 months alone, they've consumed about $100 million of free cash flow. So this is going to be a big fat X on metric number 6. And SNDL has done it. They are 0 for 6 on our Select 6 analysis. So this company is not giving us any reason to be interested in it, is not giving us any sort of risk premium or margin of safety to the rate of the 10-year treasury. Keep in mind that this analysis is beginning and holistic in nature. So even though they're 0 for 6, this does not mean that you go out and you sell the business. This analysis is not financial advice, and it is not a buy or sell recommendation of any company. Before making any sort of investment decision, please consult with the properly licensed and registered financial and legal professionals. It would seem that cannabis is going to have a bright future ahead of it, similar to what the tobacco industry had in the United States and globally. However, it doesn't look like SNDL is there quite yet. If you're interested in learning more about the business, I would highly recommend diving into the company's filings. You can read through their 10-Ks to get a deeper sense of the history of the business, as well as to understand the business's risks, their opportunities, the environment that they operate in, and how management is approaching capital allocation. And after you've done that, you can also read through the company's earnings call transcripts to get a more up-to-date understanding of the business on a quarter-by-quarter basis. So in summary, SNDL is 0 for 6 on all of our metrics. While they've grown revenues and they're sitting on $100 million in cash, those are about the only bright spots we see for the business. Their free cash flow burn rate would give them about 1 year based on their net debt position right now, without the company having to raise additional capital. They're still earning negative returns on capital, and they're not producing positive free cash flows. So it would seem like this business is a meme stock through and through, and it just goes to show you that stock price is not going to be reflective of the economic reality of a company. Remember that price is what you pay, but value is what you get, and we're not necessarily seeing the value here in SNDL. Again, keep in mind that this is not financial advice, and this is not a buy or sell recommendation of any security. So with that said, that's it for today's fundamental stock analysis of SNDL Inc., ticker symbol SNDL. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about the business with me today, and have a great day.